Mohandas Pai, some say India is losing more people and attracting a lot less money than it used to. And it is a sign of weakness. What are your thoughts on it in terms of the issues that must be addressed, by this budget or some policy intervention immediately?
Well, I don't know whether the budget will address. You see, India is losing people because 90% of young people want to emigrate. We have 1.3 million young students in outside India studying in the US and all other countries, out of which not more than 10% have gone there for genuine education. Rest of them have gone there to emigrate to get jobs because they all believe they won't get good jobs in India. And India's labor surplus is going to happen. We're not going to, that's why we got to create enough high quality jobs in our cities. But those jobs are there. Second thing, what we have to do very clearly is improve the infrastructure and the governance in this country so more FDI comes. Now we are getting $82 to $85 billion gross FDI, gross. But in the last 2 years, many of these PE funds are sold out, taken out $25, $30 billion. This year also they're selling, taking out money because the stock markets have got very high PE, very high valuation. Why should Hyundai raise money in India? Why should LG raise money in India? They come from a capital surplus country. They do it because they're making a lot of money in selling the stock and taking money out. And that will happen. But what we need to do is we have to incentivize long-term sovereign funds, long-term pension funds by reducing capital gains tax for them. Now, the government of India and Delhi doesn't understand one thing. They think, oh, Mera Bharat Mahan, the whole world is coming here. Whole world has got options. America is rocking, right? The stock market is giving them bumper returns. All the big AI companies and the tech companies are giving them 20-25% return year after year. Why will that money come here? What we should do is we should understand our currency depreciates 3 to 5%. Right? In dollar term, even if you earn 15%, is like 11.5, 12%. Second, there's the India risk premium because of uncertainties, tax terrorism. Reduce all that. Exempt them from long-term capital gains for pension funds who don't pay capital gains in the home country. Exempt them for sovereign funds who don't pay capital gains because they're owned by sovereigns. And for other funds, have a very nice tax regime with lesser tax so that they can invest and bring in dollars. So the return that they get makes up for the currency depreciation.
Okay.
I think these are important things for Delhi to understand very clearly because they're on a different league. And if you don't do that, see, most investment vehicles in the West are pass-throughs. They're pass-throughs. But if taxing a pass-through, don't tax a pass-through. Our mutual funds are not pass-through. But the people who own the pass-through stocks are pension funds and pensioners who invest for the long term. So let them take the money out. It doesn't matter. There'll be long-term players, incentivize. We need to change many things.